financial planning. Our distinguished guest for today is Mr. Deepak Malhotra. Mr. Deepak Malhotra is the Vice President of Mass Mutual NYNJ Metro. He is a certified public accountant in New Jersey. He holds a bachelor's in accounting from Keene University Union in 2009 with 3.9 GPA. He also holds a bachelor's in mathematics from ATS University India and master's in English literature from PG College. He has been running his CPA advisory practice at Northeast Solutions since 2012, providing tax and accounting solutions for small to mid-sized businesses. As an ARCPA member, financial planner with Mass Mutual Investment Co. and MDRT and NAIFA member since 2009, he has been providing financial and tax advice to more than 700 clients in the tri-state area. Our today's topic will be on credit and debt, importance of protection planning, cost of college and planning, saving for retirement, and more. Over to you, Mr. Deepak Malhotra.
Good evening, everyone. This is, as Anita said, my name is Deepak Malhotra. I'm also CPA and Vice President in Mass Mutual. I will be talking a little bit about financial planning basics, and then I'll go a little detail in how to diversify your retirement portfolio and how to be a tax efficient portfolio. I'll also talk a little bit about college funding and importance of credit and all those, how to manage your finances. Feel free to give your questions to Anita, and I'll answer when the question answer will come into the play, when the time will come in. So I'm going to start off by sharing a screen with you and a little disclosure on that. All right, so I'm sorry, just having a little understanding here. Okay. Okay, Anita, can you see the screen of PowerPoint?
Yes, yes.
Okay, so I'm not going to go too much in detail, but let's work on, as I said, a little intro about myself on the first page. And this is my phone number. This is a small disclosure. The information provided here is not written or intended as specific legal or tax advice. Individuals are encouraged to seek advice either from their tax or financial advisor or contact me at the number 732-762-9502, and we will talk about the specific situation. Our talk would be a macro, we're going to talk about in a macro basis. It applies to in a general financial planning, how a general public should plan about starting a career or going, if they have kids for college and they're getting retired. So it's just like a general conversation we're going to be having. So as you see here, what we will accomplish here today, this is the summary. We're going to be talking about identifying priorities, meaning we're going to have a brief discussion about importance of identifying your family's priorities. We're going to talk about some financial concept like budgeting, saving, debt, protecting your family, and then taking next step. Going to the next, what is the priorities? We will talk a little bit about, everybody, we have family, we have their own priorities to how we're going to manage the things and in which order. That's called priorities. Everybody knows. I don't have to put that pressure on this. But one important piece of information you will take away from today's conversation is people worry about their finances. Everybody does that, and you're not alone. My goal today is to make you empowered so you can take your next or either first step to making your short and long-term goal as a priority. All right. I think most of the people have a kind of sense to if they want to retire at a certain age, if they want to, if they have a priority to pay off kids' college, accumulate for the kids' college, paying down current debt. So something, we always have something. The whole idea is when we create we want to have some kind of a long-term goal and short-term goal in our thought process. And sometimes we also have we have a long-term goal and a short-term goal, we have some conflict. Sometimes we have a kid's college as a priority. At the same time, we have to buy a house. We also have to plan for our retirement. We need to see at that particular time if one goal can be put off for a while. So which is the priority? Meaning, if the kids are getting ready for the college, we need to plan for their college first, and later we plan for our retirement. So that's what they talk about. We need to give a priorities. We also have to we have to, and priorities also need to revisit later on. So suppose today we have a priority to save for our kids' college. Maybe a year from now we got some situation might change. My son gets a scholarship. We don't need to save for the college anymore. Now we need to change the priority. That's why he says revisit the priority. The other thing is says give your family enough time. The most important ally we have to reach our goal on time is just basically the time, how much time we have. Over the years, your money have chance to grow and compound. By articulating our goals as soon as possible, we can work towards accomplishing them. All right. The next topic is talk about family mission statement. What does that mean? Basically, as a parent, our children, our grandparent, our mom, dad, we should sit and talk about once in a while. Let's write it down. If we have some extra fund, how do we spend it? How we, gonna go for vacation? How we plan for our vacation? These kind of call it family mission statement. So if we win a lottery for sometimes, suppose $1 million, what are we gonna do with that? Do we have some charity that we wanted to plan for, give away some for charitable fund, a good cause? So that's called a family mission statement. Let's go to about when we have the mission statement written, we need to have a budget. That's what it talks about, current expenses versus long term. We all go through these are the basic financial steps that I'm talking right now. I'm sure everybody goes through. I'm just gonna point out one thing here, that budgeting is a very important tool. When we have we juggle every day-to-day responsibilities. As you see in the left-hand side, it talks about the current expense. On the right-hand side, it talks about the long-term aspiration. Current expense basically is due within couple of days or within next year or so, like paying monthly bills, mortgage, rent, daycare, clothing, kids-related costs, managing our debt, credit card, car payment, protecting our family, insurance, health, dental, orthodontics. These are the current expenses that needs to be done, taken care of this year or in next month or next day or something like that. Donating to a philanthropic.
Deepak?
Yes.
Just a minute. Can you hear me? Because people are not able to see your slides. If you could scroll to whichever slide.
Nancy? Mark, can you hear me? Now you see the slide? You can see the slides?
Yeah.
Okay, now you can see the
probably you have to scroll down. Yeah.
Okay, presentation mode. Okay.
Yeah.
All right. All right, sure. All right, so I think that we had some trouble on showing the slide. We can see the slides, Anita, now.
Yeah, probably you will have to scroll down to whatever slide you are speaking about.
All right, so this is the one I am right now in the current expense versus long-term aspirations. Okay, Mark. Can you see that slide, Anita?
Yes.
Okay, so as I talked about, we have a current expense versus our long-term aspiration. Long-term aspirations are, we have a plan to buy a house 3 years from now. We have to fund our retirement account. If you are 40 years, we are going to retire at age 60. So then, we have a 20-year to fund our retirement. Kids' college education. So if my son is 3-year-old, I have to plan for their kids' education. So when he goes to college at age 18. So these are the long-term aspirations we have. We have to juggle sometime how we manage it. That's what this is. How do we manage those priorities? That's called budgeting. Creating a budget for our family. As you see here on the left-hand side, our current expense that everybody juggle day to day, and the next right-hand side, we have our long-term aspiration. That if I have a plan, if I'm going to die, I'm going to give $1 million to that any charity. That's my long-term goal. So this is what the budgeting comes in a picture, and we need to plan. And budget is basically the thing. It just can be monitored and adjusted daily, weekly, monthly, depending on the regular interval. So that's what it. I'm gonna go to the next slide. Creating a budget. I hope everybody can see this. Creating a budget.
Yeah. Can you just zoom a little bit, Deepak?
I'm sorry. Can I zoom? Okay.
Yeah. Yeah.
Okay. All right. So creating a budget. So as I said the previous slide, goals and aspirations we have. Goals meaning short-term goals. Short-term goals are, again, paying bills, paying mortgage, paying rent, paying daycare, paying clothing, going for vacation, credit card, car payment. These are our goals, short-term goals. Aspirations are long-term. So when we have this already jotted down, we know we need to formulate a budget so we can take control of our planning. That's what the planning comes in a picture. And then when we create a budget, we have to stick to it. That this is what we budget. We account for 401k. This is the budget is accounted for college funding. This is for retirement, and this is what for our vacation. And then we have to revisit it, periodically. We can create a simple or complex. That's what this slide talks about. We can have electronic version of budget. You guys might know there's a lot of iPhone, Android users. We can download a lot of free apps that we can create budgets, and that's what it talks about, electronic version of budget. Paper budget, like old school style, you can create in a paper pen and then create a budget that can be monitored. Now the most important thing is to understand is these 4 things: net household income, fixed expenses, discretionary spending, and estimated saving goals. This is the most important thing that everybody needs to understand when we create the budget. I hope a lot of people will know this. What is net household income? Net household income is like after taxes, what is our take home? So if my husband is making 100 grand, wife is making 60 grand, total 160, but after taxes, Uncle Sam takes some share, and then we pay Social Security, we pay Medicare taxes, depend on what kind of tax bracket, you pay some other taxes also, and then what we bring home, that's called net household income. So we need to know that when we're creating a budget, we need to know that. Fixed expenses are, regardless of my income goes up or down, we have to pay that. Those called fixed expenses, meaning like mortgage, that's called fixed expenses, like rent, food. We still have to pay. Repayment of college loans. We have to do that regardless, right? Different type of insurance, we have to pay that. Then third one is discretionary spending. Discretionary spending that basically calls nice to have. Buying an iPhone, like iPhone 7 came in, now I want to buy that phone. These are the discretionary. We can live without it, but we need to allocate some amount. We need to know that allocate some amount towards discretionary spending, and we need to have the saving goals. And as I said, the last line, if you see that, it says discretionary spending may differ from one family to the next. What does that mean? Meaning, for some families, discretionary spending could be a kind of fixed expense. Some people think having unlimited data on my iPhone is, I have to have that because I do. So it's become like a fixed expense at that time. For certain people, they're happy with only the talking in the phone. They don't need the data plan. That's called some discretionary spending are fixed expense for some household income. These are the things that we need to understand a little bit about when we do the budgeting for our financial planning. So I'm going to go to the next slide now. that basically tells, I hope everybody can see this, is there's a pie chart here. It says the typical monthly expense. Anita, you can see that slide?
Yeah.
Okay, so what does that slide meaning? Is this slide is basically is a for household who's making 100 grand a year. You know, we're taking as the average people make. I should not say average, meaning most of the people make if husband wife both works, they make $100,000. So according to the 2015 IRS data, I'm taking that number. If somebody makes $100,000 a year, his monthly take-home income would be roughly around 8,300. Okay, and then after taxes and everything would be 6,250, as you see on the top. This pie chart, everybody can relate to that. As you see on the right-hand side, if you're making 100 grand a year, 6,250 is your take-home. And then, as you see, this allocation is mortgage, utilities, college loan, credit card, auto expense, groceries, family phone plans, clothing, daycare. These are the pie chart. We all can relate to that. Right? As you see, a pink chart on the $400, that's what they're coming up with. So if they take care of, that's called the budgeting. We put all the numbers in. I make $6,250 a year. $1,300 goes towards my mortgage. This I need to pay for daycare expenses. This is my, spending habits or the discretionary. And now you got to come up with some number that you can save. I hope everybody can spend money according to their income. We're not spending more what we get. So if we do that, we're definitely going to have some income that we can put aside. That income we need to plan. Are we going to put towards a investment? Are we going to put towards a 401k? Are we going to open another some kind of IRA plan? Or depends. So this is the number that we have to come up with somehow when we do the budgeting. I'm going to go to next slide now. That talks about importance of savings. As I showed you previous slide, it's that we came up with some number after doing budgeting that we came up with the $400. Everybody knows. I don't have to explain what is the importance of saving. Why do we save? We save because we want to prepare to be unexpected things. Things happen, right? We don't know what can happen in future, but always we plan. Support. And the next line is says achievement of short-term and long-term financial goals. If everybody remembers, I showed on the second slide short-term plans that needs to be fulfilled in next year or so, and long-term that we usually plan for college, retirement. That's what we save. That's why we save, because we want to achieve our short-term goal as well as long-term goal. And then as I said, finally, the third reason is to save money for financial freedom. That financial freedom we all look for. When you have money saved, you have more choices. Less money saved, we keep working until 70, 80, I don't know up to how long, but with that time we keep working. So we have to come up with some kind of budgeting plan in our whatever take-home income is, and make some short-term, make long-term goal, and create a plan so we can lead towards a good financial future. Now, next slide is going to talk about probably what is the small savings. Some people say, all the expenses, I make $4,000, $5,000 or $6,000 a year. I spend it out. I don't have money to save. I'm leaving only $100 a month. It's not too much. But this is the slide. It tells you $100, saving $20 a month, saving $50 a month, saving $100 a month. This is also goes a long way. If $20 each week, if you can save it for 52 weeks, you save almost $1,040. End of the year, with this $20 per week become $1,040. $1,040, you can buy something, right? Nice. The same thing, saving $50 a week is saving $150 a week. I'm sure a lot of people are making a lot more than that, and then they still don't save. But this number can be higher or lower, depend on how much you have, how much you're making, how much you take home, what are your expenses, and all those. So all this slide meaning that even the small amount we save later on, end of the year or end of 2 year, 3 year, it accumulates. And that's what, and then it says the power of compounding. That's the whole thing. I'm sure everybody invests money in a right way so they make good return. But let's take a very conservative number, 2% interest, just 2%. So look at the 10-year period. If we save $50 a week, 2% interest will give you $29,000 in 10 years. I'm sure we earn a lot more than 2%. We expect to earn more, a lot more than 2%. We are financial savvy, educated people. But all I'm saying, even if you put in a bank earning 2%, still you can accumulate up to 20. So the whole idea is being disciplined, not meaning the return. So a small amount of increment also goes in a long way. That's what it talks about in the 10 years of saving. Now, make a saving possible. What does that mean? Important thing to remember here to start saving and boost your saving over time. That's what it is. Now we're going to talk about we talked about the budgeting and saving. It's important to decide where we're going to put our money. We have a lot of options, right? That's what I'm going to talk a little bit, how you should plan on retirement, how we should diversify our investment. That's a whole lot of discussion, but we are talking as basic right now. We have a payroll deduction. Most of us, we work for any kind of employer. They provide payroll deduction, and then we can set aside some money. We can hire a financial professional who can tell you how to save money. There are a lot of investment options, stock, bonds, mutual funds, ETF, real estate investment. But all it means, you gotta be disciplined. Keep doing things, keep putting money aside. That's what it means, making saving. You can start slow. It doesn't mean that you need to have 100,000 all the time to have a big. Just start slow, whatever you can put aside. That's basically. Now here is very important planning. When we make this, how we should plan, the planning, right? I'm going to touch a little bit. I'm going to stay into the same screen. We'll talk about some planning tools, right? Most of us, we will have three types of planning. We want our personal planning. Personal planning includes college funding, retirement, 401k, investment, savings, buying real estate or something, a rental property, something like that. Then we have a business planning. We want to buy a business, right? And that's what we are saving. That also need a right kind of planning. You can't just buy a 200,000 and you go and buy a Krauser and start running a business, because you need to have a proper planning in place. Otherwise, what will happen eventually is this whole $200,000 will go down. I'm not saying it's gonna, but you might lose money. So that's what the business planning comes. Now the third very important feature is called tax planning. It's called estate planning, estate tax planning, because all life long we work hard for our kids, and the end of the our life we have a $10 million saved, $5 million saved. But think about that. If we do not have proper planning, there's a tax called estate tax. I'm sure most of us, we know about what will happen. There's a federal exemption currently, 5.3 million, and New Jersey state exemption 750, I think 675. It now is going up to million. That's it. And more beyond 1 million and 5.3 million, anything that we are leaving, the government charges taxes. The federal government takes 35 to 55% of estate tax. Our kids has to pay to release all the property. The same thing New Jersey state is going to charge. So that's called estate planning. So these 3-4 kind of planning. And tax planning is just basically we have to pay the legally whatever money we make tax to IRS. But there is some planning you could do with your CPA, your tax advisor, whoever you work with. That's another third kind of planning. So we minimize taxes, we minimize risk. I'm going to touch a little bit about here a cycle of saving, how we plan, financial plan. When we are younger, 30-year, 40-year-old, the most important capital we have is human capital. right? Because if I'm not here, I'm 40-year-old man, if I'm not here, how my family is going to survive? I have an earning potential. I'm bringing money, $100,000 a year or $200,000 or $300,000 a year every year to year by year. If I'm not here, then who's going to bring that 20 years, 30 years next down the road money to my family? That's called human capital. My human capital is high because I'm young. The older I get, my human capital slowly decreases. Why? Because we accumulate money, right? When we accumulate money slowly, our financial capital increases and human capital decreases. When I reach 70, our human capital is a lot less because we're not making money that much. What we are doing that time? We accumulated money. We protected our human capital. Now we're doing a distribution. Now, what planning do we need at that time at age 65 or 70? How we manage our distribution. Are we managing it properly? Are we taking distribution right? Are we doing it in a tax efficient manner? Are we doing it in a that our distribution, our accumulated money is going to go a long way? There are risks. Everybody knows that longevity. Now we live longer, thanks to the medical advance that we're living longer. Everybody knows we get Social Security, and Social Security has also. I'm going to show a slide here. I mean, I'm sure everybody can see that. I'm going to share a different slide so you guys can see it. Look at the Social Security. What do they say? Now they're working on it. Everybody knows that now there was a glitch in Social Security. They fixed it. As you see here, what they say by 2088, if the Congress doesn't make any changes. Oh, I'm sorry.
Just to interrupt you, are you sharing something else?
Yeah, I'm gonna share. I'm sorry. I'm gonna change the screen 1 second. Okay. I'm gonna change a different screen now. Anyways, let me share an entire screen. Okay. All right. Now look at this slide. I hope everybody can see that the view from 2014. Everybody can see that?
Yeah.
Okay. What does that say? 2088. If no changes in taxes, benefit, or other assumption, revenue covers. What does that mean? Revenue covers 75%. We count on Social Security, right? We're gonna get Social Security in our retirement. But if the Congress doesn't make any changes, they are having a shortfall. So each dollar they can only pay 75 cents by 2088. They can't pay the full Social Security benefit. That's what the planning comes in a picture, because we plan for retirement, how we need to get paid and all those, and Social Security. I'm sorry, I think got Anita, can you see my screen? The slide again?
Yeah. Yes.
Okay, I think I'm on the wrong slide. Sorry, 1 second. All right, so let's go back to that. Go back to the same saving part. So I was talking about. I'm sorry, there was some disconnect on the internet side. So I was talking about this retirement planning techniques. When we have those savings done, it has a long-term impact on our retirement. How do we plan? How do the state tax is going to be handled? How we are saving money in a 401k. There's another important thing to consider when we make those plans as a saving. It's called tax diversification of our retirement income. What does that mean, tax diversification? Social Security is, yes, we pay Social Security. We get the money paid by government when we reach at age 65. The other important thing, we don't want to pump too much money in one side. What does that mean? If we have a 401k from our employer and they match it, we definitely want to take that advantage. We still want, if they don't even match it, we still need to put some money in a 401k. The reason because right now we are in a higher tax bracket. When we make money at younger age, we save money, we save taxes, in a higher tax bracket side. When we retire, usually, I'm not saying 100%, but we are in a compared to today's tax bracket, we are in lower tax bracket. So we withdraw money in lower tax bracket. But we do not want to pump all the money in one side, meaning all money in 401k unqualified. These called qualified funds. We keep funding money. No, we want to have a some after tax bucket as well as a pre-tax bucket. That's called tax diversification. So these are the saving tools you might want to utilize so you can basically do the planning in all aspects, not only one aspect. Especially when the people start making a lot more money, that these planning tools are very, very important. Estate planning, personal planning, business planning, and then as well as the tax diversified planning. All right. So I'm going to go to next screen, make saving possible. When we go to what are the other challenges? Right here. All right. Controlling debt, very important feature. When we, I hope everybody can hear me. See that controlling debt screen? Can everybody see this controlling debt screen?
Yes, Deepak.
Okay, very good. So we talked about the importance of saving. Now we can argue it's important to control families' debt also. When we saving, it doesn't mean that we start saving and in the one side at the same time we start borrowing money. It's called debt. It's almost impossible to live debt free because we can't pay all the things. We cannot buy everything for cash, right? Especially for when it's buying home or college education. But we need to determine, we need to juggle what is the good debt, what is the bad debt. I'll tell you what is the good debt. Good debt is basically any debt that we can't afford to pay for upfront without clearing out our emergency saving, like a money account or cashing any investment. So if we have a $40,000 saved in our emergency reserve or a money market, and we have a 401k, but we need to buy a house, right? But we can't buy it. That's called good debt. We can't afford to buy a house, right? That's called a good debt that we can't afford to pay upfront without clearing out our money market account or cash account or emergency saving account. Emergency saving also, that's a very important topic I want to touch here. Emergency saving is just almost 5 to 6 times of your expenses, or you can think about 3 to 4 months minimum, 3 to 4 months of your take-home salary. Things happen in life. That's what the emergency fund. So if we are good debt, meaning we buying a house, we don't want to touch our emergency reserve at that time. That's called good debt. But the bad debt includes debt we technically not necessarily need, but we still buy it sometime. We take a vacation on credit cards. We buy clothing on credit cards, buy new technology on credit cards. These called bad debt. It's very, very important to understand what kind of how we are making our choices, because these choices have a long-term impact in our financial future. That's called good debt versus bad debt. Taking a college loan is a good debt. You can buy it because nobody's going to pay the college. I mean, people do that. I'm not saying, but if you're buying for college for education purpose, it's not a bad debt. It's a good debt. Now, accessing of your credit report is very important when we're doing financial planning for our family. We need to periodically. I hope everybody knows that every year we can access free credit report from 3 credit bureaus. That's called Experian, Equifax, and TransUnion. They each collect information from your credit history, is credit report, and we can access that. So we need to access it every year to see what is the credit score. Why this credit score is important? Because when we are young, we're going to have a long-term financial journey, right? We want to see our credit report go up, because when we get a job, right, our employers check our credit history. We're buying a house, they look at our credit score, and according to credit score, we get the interest rate of interest on the house, on the buying a car, or any kind of debt we are taking. So that you get a privilege of having a good credit score. So we need to maintain that. And how do we maintain it? There are some inaccuracies. Sometimes they make mistake, the human error, and that's why we have to check it every year. Every year we can access one-time free credit report. Now, repaying debt, what does that mean? Sometimes we buy debt, like buying a 10%. A lot of my clients, I don't have to say that, but people take money from credit card, and do things like they're not supposed to do sometimes. So we need to check. It's very important to see if we have too much debt. How we fix if we have too much debt. We need to go back to the basics. Look at our budget. Where are we spending money? How much money we getting every month, and where are we spending? We might have to cut down some. If we're buying too much of Starbucks coffee, we can cut down, right? It's like even $100 a month. If we can cut down, we're going too much in restaurant, we can cut down. So because we want to pay off that debt, so it's very important to not to have too much debt. Because once what happens if we keep taking debt, and then credit card company is giving debt, once there's a point is going to come, they're going to stop giving you credit. That's what is repaying debt, meaning we have to be very, very careful on the debt side. Next slide is protecting your family. It's very important. We talked about importance of saving, leveraging, access, our credit card. All it makes sense. But think about that. The scenario when unexpected things happen, right? We got to plan for that. Not necessarily these times. It happens in these kind of situations, and I wish it never happens to any family, but things happen, right? And these things we can't control. We have to have a designated account so we can set aside some emergency reserve. That's called emergency reserve for 5-6 months of saving. But we also need to plan about if something happens, if we can't work, become disabled, possibility of being out of work for some period of time, a layoff happens, injury happens. What happens if I'm no more? Will my son or daughter can go to the college? I'm making money, but I'm not planning for my, if I'm not here. What happens to my wife? Can she stay in the same home? Can she pay the mortgage? How much tough time they are going to go through, right? If I'm not going to plan properly on that side. So it's very important. Who assumes responsibility over the children is the next line. It's very important. Can they enjoy the same luxury? So we got to do all those kind of things, and we have to plan accordingly. It's a very cheap. We can buy a term insurance. I hope everybody knows that, to protect our loved ones. And if you cannot afford to buy a permanent insurance, it's a very, very strong tool, and I do recommend. I do own it on my own, big time. I own it for my son, my daughter, a permanent insurance. We should own it because that becomes eventually a great estate tax planning tool. And when we buy a permanent insurance, it's very important to think the company we're buying with. Company has to be strong. We never want to buy investment with those kind of risky assets with the insurance. That's what my idea is. People do it according to their own thought process. But when we buy a permanent insurance, we need to look at how strong the company is, what dividend they are giving. I know everybody knows I'm Mass Mutual vice president. I love this company. It's a very strong company, consistently giving good dividend. Historically, things can happen, no guarantee, but it's a very, very strong company. Highest top rating, 7.1% current dividend. So we might want to get into that kind of investment when we're buying a permanent life insurance. If we can't do that, then buy a term insurance, at least protect our family, right? And another thing, if we become disabled, the most important human capital we have is our own earning potential. We need to protect that. It looks like a lot. I do that, I buy life insurance, I buy disability, I do 401k, I do investment, I do real. But that's what the budgeting comes in the picture. Do it pretty basic, if I become disabled today, Social Security is not going to pay me right away my disability. Next 6 months, I'm going to be out of my cash inflow. So I'm going to plan at least my basic expenses are covered. That's called disability. We need to plan that also. And we should. That's the way it is. All right. I talked about, term insurance, 30-year term also some company offers. If we can't afford to buy a whole life or permanent coverage, we can buy the term insurance. Now, I talked about, these things, how to take action on these things. We got to commit a small amount. Bottom line is we have to be disciplined. Any investment we do, any kind of planning we do, we have to be disciplined and we have to be consistent. That's it. And then, you have to set a realistic goal. You don't have to be crazy goal. Like if I'm making, that's why you need a financial advisor help to determine what is the amount you should be putting in what area. You don't want to make just, if you have $1,000 saving, let's go and buy $1,000 per month, buy a stock. And you get $1,000 buy a whole life. No, you just create a budget. How much money should go on which bucket? That's all. I'm going to share a last slide with you. Now involve your kids. It's very important. Involve your kids. I hope everybody sees that. It's important to talk to your kids when it comes to creating a budget and spending habits and all those, because they need to know how we as a parent work hard for them. And they need to understand. We need to involve them. Now, when they reach a certain age, when they understand our conversation properly, especially when we talk about the money, we get to tell them what to do, what not to do, what to invest, which thing, what to buy, what not to buy. And we have to make them realize how hard we work to make this money. And then so they are a better person in future, and they plan their future, financial future accordingly. That's called involve your kids. I'll take questions also, but before I do that, I want to share one more slide and think I'm almost done. Let's see here. All right. Yeah, two bucket system. It's important, especially for the people who have businesses. I hope everybody knows what is probate. It's called estate planning tool. Two bucket system. If the person who has a business, they need to not even you. It doesn't have to be business. Meaning, everybody needs to know that what is called private assets, what is called public assets. Private assets is protected from creditors by law. That's called life insurance, cash value life insurance technically, or death benefit of life insurance, annuities, and retirement account. That's what we always say, put money in a 401k, put money in an IRA, buy some life insurance. Public assets are your home, your real estate, stock, mutual funds, saving, checking, business, CDs, bonds. These are anybody can access. And when I say anybody, meaning in things happen, and if government can put a lien on those, people can put lien on those, these are a public asset. They can access it. In a case of these are unsecured. So these are the things we might want to understand as Finance 101. What are the private assets and how we should keep some of our money in a private asset. That's what we put money in 401k, because these are protected by statute of law. That was my last slide, and I'll take any questions you have. I hope everybody got something out of this session.
Yeah, thank you, Deepak. This was very insightful and very informative, especially the importance of saving and then the insurance and then the two bucket system. Yeah, going on to our question and answers. Our first question is from Mark. What should one look for in a credit report other than the credit score?
Yeah, so good question. What we should look for other than credit score, we should look for sometime delayed payment. Like every month when we make payments on credit cards, sometimes we miss it. And after 60 days, they report to credit cards. Sometimes you do make the payment. Sometimes people have your social security, date of birth, and all the information personal. They open account, and sometimes you don't know. You don't get any notification. Somebody does a fraud. You move from you live in a Piscataway and you move to Addison now. and somebody has your information, they open your credit card, they send the information to Piscataway address, and you never got the mail, and their account is open on your name. And that person who stole your identity, he's using your credit card and paying the debt. You never get any notification. And once he stopped paying the, your monthly payment, and he access all your credit, you are personally liable. Then you have to fight with all identity theft. So every time we need to see the credit report has all the information, how many credit cards we have, are they reporting it, all the credit card companies reporting it on that I'm paying on time. The second important thing, they make mistakes sometimes. Somebody else's information, they put it on. I'm not saying it happens very often, but we are human. There are also people who are sitting on Equifax, Experian, all those credit company. They're also human, make mistakes. It happened to honestly me once. There was one issue. They never updated their system, and it was lying around in my credit report. And then finally, I have to write them with the detail with all the things, and they fix it. So we got to look at the detail. Sometimes it's 80 page, 90 page, 30 page. All you need to look at the credit card number. It should say pays as agrees. And it will tell you if you're delayed on any payment. And sometime also you have a credit card that you have not been using it, and then you maybe you throw it somewhere, and somebody got that credit card, he uses it, and you don't even know that. So looking at that credit report, you can see all those things, which credit card has how much balance. I hope that clarifies a little bit.
Yeah. Okay. Our next question is again from Mark. Could you please share how permanent life insurance on children be a vehicle for college saving?
All right, so I'm going to go a little detail in this question. Permanent life insurance, how could be a saving for college? It's a tool. You can supplement college from permanent life insurance, but that is, we use as a tool a whole life of permanent insurance as a college supplement. As everybody knows, that there are college plans called 529 plans. There's a covered education plan. Most of us, when we are high income, we don't qualify for covered education. The next one is 529 plan. And there are some good 529 plans. There are some okay 529 plans. But the only problem is sometimes if the market particular, if you do not have a right financial advisor, and then I'm sure you do, but if you do not have it, what happens when the kids are ready to go to college and it's not properly aligned, then market crashes sometime, and then investment can go down. What you could do, you can supplement, you can just diversify, I should say, a little bit of money on a permanent insurance, and then you can borrow money from that life insurance cash value to fund their college. I have done for my both kids. When they born, I bought a 20-year guaranteed plan, but at that time you have to be very clear which company you are choosing. Company should have a good history of dividend, so you can see that those dividends are, you can foresee in future they coming on, is slowly by slowly growing your cash value. And what kind of plan you buying, that is also very important. You don't want to buy just a regular cash value plan. You want to buy that gets paid up when your daughter or son is ready to go to college, so you can withdraw 50, 60, 70% of fund. The another beauty of this college plan, that it does not affect your FAFSA. Versus the 529 plan, when you are do that, they usually goes sometime against your FAFSA, not all the time, but sometime. But this plan doesn't go. You can borrow it, and then you can put it back. So 3 years you use it, right? You use it. Suppose you have 100,000 cash value, you borrow 50,000, you put it back again 50. Now it grows again on the dividend with the way company is paying. So I would talk in detail on a specific situation, but it's not only the way to fund it. I should not say that you should only fund with this permanent life. This is another tool that you can supplement college, and very strong tool, I should say.
Okay, thank you for that input.
Sure.
The next question: when your company offers a 401k, do you take the pre-tax or the post-tax option?
Yeah, it depends. You should take, if you are basically high if your bracket is really high, you should choose pre-tax. There are 3-4 things you might want to consider. Like suppose if you are an age 40-year-old right now and you have been putting money in a pre-tax 401k when you were aged, when you were 25. So 15 year you pump a lot of money. Now that balance goes to $1 million right now. Now if your company offers you after tax, it's not a bad idea, right? Because you have never taken that advantage. It's not a bad idea. Now another scenario you might want to think, when you are very young, you're 22-year-old, and your company offers, after tax 401k, not a bad idea. Because you're very young, you have a long way to go, so you get the money, let the money grow tax deferred and access it later on. As I said, but from my understanding, what I always think, you should have decent amount of money on pre-tax side, because later down the year when you enjoying your retirement, you're not going to be in that much high tax bracket. Usually you might be, because you have a lot of real estate and you're getting a lot of income at that time. You might be. It's just like, but it's always 60% of the time it works out you are a high tax bracket on earning years when you are young. So you might want to take advantage, pre-tax side. But as I said, it depends. If you have a lot of money on pre-tax, then you might want to consider that option. And if you're too young, 22, 23-year-old, then you might want to also, not a bad option to do that.
Oh, okay. Thank you.
Sure.
What are the other ways of saving for college apart from the 529 and the insurance options?
That's about it. You can have a crummy trust. That's another people do it. There's a trust planning people do, but there are also people put money in it. So who would like to do the crummy trust? Crummy trust is the people who want to take control of the money, but they don't like the 529 plan option. They don't like life insurance cash value, because it doesn't grow that much, 5-6% in the longer term, or 7%. That's it. They want to make a little more money, and they are very financial savvy, and they want to do investment. Then people put money in a crummy trust, and there are some trusts that can also be grantor trust. There is some planning that you could do. There's another called UGMA account, Uniform Gift to Minor Act, Uniform Trust to Minor Act. These are the tools, but as I said, these are little detailed, but there are ways. The bottom line is, if you are a kind of person who wants to put money and you're very financial savvy, you know where to make money, or you have a right person who can advise you, in that situation you might want to go. But the risk always there. Wherever you put the money, it depends on the market, how the market on that particular sector will perform.
Okay. The next question. What amount one should plan for retirement monthly income based on current expense?
I'm sorry, say that one more time.
What amount should one plan for in a retirement monthly income based on current expense?
As I said, it's the budgeting is the tool that everybody should use. It based on how much money you make. The rule of thumb is, if you make you should save at least 10% for your earning. If you're looking at the gross number, if you make 100 grand, and if you can save 10%, I think you're doing the good job. If you're doing 20%, it's a very good job. But if you're doing like 3%, 4% of 100,000, you're only saving $5,000 or 4,000. It's not a bad number, I should say, but this is what you need to look at, the gross, like 5% to 10% of your savings should be their minimum. That's what and expenses. If you're asking according to the expenses varies depending on family to family. If somebody they buy the property in India or some other country, they have to pay off that debt. I would recommend you paying off that debt, because that is like a 12% debt people get in some countries like India. These things depends on each individual, how your expenses are allocated. Then you need to come up with some investment plan for yourself. The debt plays very, very big role. How much debt you have and what are expenses you have, where you want to cut down and how much. But you have to come up with some plan that you can put some money aside for savings on retirement, a 401k. It's just a matter of being disciplined.
Okay. Okay. The next question. Company sends a letter stating that I can take a lump sum distribution on my pension. Should I use this option? This is my ex-company asking.
You see, this is also based on, there should not be a one advice that I can give you. You should take lump sum or you should take a periodic annuity. It's based on what is the interest rate they are giving you. If they are annuitizing, we need to see how much annuity you are, what interest rate they are giving you on that investment. If you take a monthly or periodic payment, what they are giving you, and you have to compare with some market investment. You need to take some advice, anybody's help on this. That's what my recommendation would be. And another thing is important. You might want to find out how much your living expenses at that time, what are your priorities at that time, where are all your other assets are placed. Maybe they have a debt, something. So there can be a one advice. It's just based on a little bit more facts. Then you should make that decision to take lump sum or take some periodic withdrawal. The most important thing, you might want to see what they are giving you periodically. If they pay you annuity kind of investment, then you need to see, is it good for me, because you might lose control at that particular time. So you might want to get all the options to the table.
Okay. Thank you, Deepak.
Sure, my pleasure.
We are done for today with all the questions, Q&A session. Thank you very much for this session, and this was really informative. I'm sure all of our viewers have definitely benefited from today's session.
And I'm just going to say again the last disclosure that these are that I give you. These information provided is not intended for any legal advice or tax advice or any financial advice. I would encourage you to seek advice either from your tax or financial consultant, or you can contact me and I can just guide on any specific situation we need to determine. And again, thank you so much for inviting me and having me here to speak to your group. And I wish you all the best for all of the members.
Thank you very much, Deepak.
Okay, Anita.
Yeah, we end this session today. Thank you.
Okay. All right. Thanks.